The 2026 Iran war has shattered global stability. The Strait of Hormuz is dark, and the economic consequences are closing in on the United States now. This conflict has introduced significant uncertainty and stagflationary pressures. While the US has some insulation, the impact on growth and inflation is structural and imminent. The closure of the strait caused gasoline prices to surge immediately. Even with robust domestic shale production, the US is not buffered from the broader damage. Gas prices rose 5 to 10 cents per gallon daily. Historically, consumption begins to decline within 2 months of such a shock, staying depressed for half a year. Inflation estimates for 2026 have been adjusted upward. Core PCE is now expected to hit 3%, fueled by the energy shock and recent tariff hikes. This places the Federal Reserve in a precarious position. Markets expected interest rate cuts, but the Fed is now forced to remain on hold for the remainder of 2026. The central bank must weigh the trade-off between fighting inflation, which risks a hard landing, and easing policy, which could unanchor long-term expectations. Before the conflict, real GDP growth was forecast at a solid 2.8%, boosted by the One Big Beautiful Bill tax cuts. Those gains are now evaporating. Due to trade disruptions and cratering business confidence, analysts have adjusted US real GDP growth forecasts downward to as low as 1.5%. Military escalation is driving US defense spending to heights not seen since the Korean War, pushing the budget toward a massive $1.5 trillion request. This sharp rise in spending adds to an already outsized deficit, putting significant upward pressure on Treasury term premiums and long-term bond yields. Financial markets reacted instantly. The Dow fell over 400 points as global investors braced for a new era of volatility and tightened financial conditions. The US 10-year Treasury yield climbed to 4.1%. Conditions are tightening across the board, and the margin for error has disappeared. Yet in the chaos, the US dollar strengthened. Global investors are flocking to it as a safe haven asset, seeking shelter from the geopolitical storm. A stronger dollar may offer a slight reprieve by making imports cheaper, but it is a small shield against a massive stagflationary wave. To summarize, energy costs are hitting consumers, debt is surging to record levels, and GDP growth is being revised into the kill zone. The convergence of these risks is no longer a theoretical exercise. It is happening now. The US economy is navigating its most dangerous passage in decades. This isn't just a regional conflict. It's a global systemic shock that tests the very foundations of the Western financial architecture. The gap between paper markets and physical reality is closing. Real wealth is weight, and the weight of this conflict is immense. Prepare for a prolonged period of volatility. The shift from farms to servers has not eliminated structural risks, it has only accelerated them. The data is clear, the systemic risks are closing in. In a world of paper promises, your assets must remain hard and your head must stay clear. Stay sharp, stay liquid, and keep your assets above the noise. Subscribe to the Aurelian Report for further briefing on the convergence trap.